So we talk a lot on this channel about IRRs, equity multiples, and sale values when you're running an acquisition analysis on a new deal, but this is all only really relevant if you're planning to sell the deal that you're looking to acquire in the first place. Now, when you're working for a real estate private equity firm that gets paid on the back end through promoted interest or potentially fees associated with selling the property, the deals you underwrite are going to be evaluated based on your projected cash flows, usually over a 3 to 10 year period, and then a sale is going to be projected at the end of that assumed hold period where the profits are going to be captured and the deal is going to be exited. But what happens if you're just buying a property on your own or with a handful of family and friend investors and you plan to hold the property indefinitely? How do you analyze a deal when that's the case? And when you're not planning to sell a deal, do metrics that are commonly used in the industry like the IRR or equity multiple even matter at all? Well, if you're looking to buy real estate and looking to hold for the long term, in this video, we're going to cover 5 things you should be looking for in buy and hold forever deals, the specific metrics you should be looking at in your analysis of those deals, and some things you might not be thinking of that are going to help your chances of long-term success in the real estate investing game. Hey, this is Justin from breakintocre.com, and if you're new here, on this channel we talk about real estate investment analysis and real estate investing careers. So if you're looking to break into the industry or do your first or next commercial real estate deal, make sure to subscribe to the channel and hit the notification bell so you catch any new videos as soon as they're released. So when it comes down to it in the commercial real estate industry, money is made in transactions. And this is true for brokerage firms, private equity firms, lenders, and even other third parties like appraisers, title companies, inspectors, and any other companies associated with the buying or selling of commercial real estate properties. But for commercial real estate investors, especially individual investors without third-party equity, that money that is made in those transactions is actually coming out of their pocket through things like brokerage commissions, legal fees, escrow fees, loan fees, prepayment penalties, and a host of other nickel and dime costs that add up significantly over an investing career. And to avoid this, many real estate investors who are investing for cash flow and wealth accumulation over time will employ some sort of a buy and hold forever strategy to reduce their transaction costs, take advantage of long-term growth in real estate values, and ultimately own assets free and clear once debt is paid off over time. And I'm assuming that if you clicked on this video, this is something that you've either considered in the past or you're considering today for many of the reasons we've talked about throughout this video already. And if that's the case, if you're looking at a deal with an indefinite hold period, how do you actually analyze a deal like this? Well, there are a few things that I have to say about this, and number one is that in an indefinite buy and hold scenario, the first thing that I would do is expand your analysis period. So most real estate financial models are going to model out cash flows for about 5 to 10 years, but if you're thinking that this might be a generational deal that's going to be held for many decades to come, extending that time frame out to more like 25 or 30 years is going to be a good move. And obviously, it's hard to know exactly what's going to happen 30 years down the road from now, but especially in later years, growth of things like operating income or overall property value can start to compound pretty significantly, especially as time passes. And this means that a 2% annual assumption for rent growth in one market versus a 4% annual rent growth assumption in another market is going to have a massive impact on your cash flows 30 years from now, and you'll definitely want to see that if you plan to hold the deal for an indefinite period of time. The 30-year hold projection could also show you personal milestones that you might be investing for in the first place, like how much cash flow the property will generate when you hit a projected retirement age, the cash flow the property will generate when you have a kid that's ready to head off to college, or any other major financial goal that the property investment could be helping out with. And speaking of this, aside from extending your projected hold period in your model, the second change I'd recommend making for a long-term hold deal is to track your property value and equity value on an annual basis in your model. So in a short-term 3 to 10 year hold analysis, it's usually pretty sufficient to only look at what returns look like for about 1 to 3 different potential hold periods, but for a longer term view, a year-by-year value and equity comparison can be a really helpful metric to have readily available in your analysis. And if you don't plan to sell this deal at all, this is going to give you a good idea of how your equity is growing over time and also the outstanding loan balance at different times of your analysis if you're planning to finance the acquisition. And speaking of debt, this can also really show you the effects of leverage and how that can magnify your equity returns. So at a high level, you probably already know that big value increases in your property will mean bigger equity value increases with more debt, and big value decreases in your property will mean bigger value decreases with more debt as well. But this is something you can see much more clearly through modeling this on an annual basis. Now, to do something like this, it usually doesn't need to be too much of a granular exercise, especially when your hold period is out to a full 25 or 30 years. So just applying some sort of assumed cap rate to each year of the NOI in the analysis is generally pretty sufficient to get a good idea of what this could look like in future years. And this is going to be really helpful in showing you a ballpark equity value in your deal over time. Now, speaking of equity, the third thing I'd recommend changing in an indefinite hold period analysis is to track your time frame in which all equity invested is returned, either through operating cash flow or through a refinance. So many investors will refer to this as recycling capital, meaning they're getting back their initial equity investment and then they're able to turn around and reinvest that capital in another investment vehicle or potentially another real estate deal. And the sooner that capital is returned, the more dry powder investors have to invest in more deals. So the shorter the payback period, the more real estate you can acquire in a shorter period of time. And with the annual value tracking that we talked about in the previous point, you can also test when a refinance would return all capital based on your assumed property value and an LTV or loan to value ratio, which can also give you a good sense of when you might be able to recycle that invested capital fully and go out and buy another deal without having to dip into your own pocket again for investment funds. So especially when you're trying to build a portfolio over a long period of time, the more you can use lender capital to do this rather than just relying on your own savings to come up with equity to invest in every deal you acquire, the more quickly you're going to get to your investment goals. Now, aside from these first 3 points, the fourth thing I'd recommend doing for an indefinite hold period scenario like this is to take a much deeper, more holistic view into long-term demographic changes in the market that you're analyzing. So while things can change a lot in 3 to 5 years, things can change significantly more in a 25 to 30 year period, and making bets on things like migration patterns and job growth in a market become much more important as you stretch out that projected hold period longer and longer. So asking yourself questions like, will technology make people more or less likely to move here? Is there natural disaster risk that is going to significantly impact the city over the next 30 years? Or what are taxes like in the state that I'm analyzing, and where might they go in the future are all going to be much more important over an extended investment time frame. And these are all things that directly drive rent and value growth in cities. So having some forward thinking on these factors when analyzing a long-term acquisition is really important in making sure your capital is invested in an area that you'll actually want to be in several decades from now. And finally, after taking all of those things into account, the fifth and final change I'd recommend making for an indefinite hold period analysis is to shift your focus from the IRR and equity multiple targets that you may have been targeting for a 3 to 10 year hold and change those to cash flow and equity value targets over time. So while many private equity investors look primarily to the IRR to make investment decisions, a positive IRR requires a return of capital and a final cash flow date, meaning that this is really only a relevant metric if you plan to sell the property at some point. And if you don't, looking at a cash flow metric like the cash on cash return when you first acquire the property to see a percentage of the equity invested that you'll be distributing to investors or yourself each year, or even a pure cash flow dollar amount that's going to be distributed each year later on in the hold period is going to be a much more relevant process to come up with a valuation for the property based on your own investment goals. And with this also gives you a much more tangible metric to lean on, since knowing a property is going to produce something like $50,000 per year in cash flow 15 years from now is going to help you plan for the future much more than knowing that your IRR is 2.1% in year 15 of your analysis. So at the end of the day, no matter what, a long-term hold analysis for a deal you're acquiring on your own should reflect what you care about personally. And whether that's your cash on cash return when you buy the deal, the cash flow the property will generate when your kid goes to college, or the income the property is going to generate for you in retirement, make sure that you're modifying your analysis to include everything you're looking for to make the model relevant for you in your specific situation. And if you are looking to learn more about how real estate financial models like this work, make sure to check out the free Breaking a CRE Real Estate Financial Modeling Crash Course, and I'll link that in the description below. And if you want to learn more about how to actually build and customize your own real estate financial models for any sort of long-term deal you're working on, make sure to check out the full Break Into CRE Academy program, and I'll also link that in the description below. So I hope that was helpful if you're looking at a buy and hold indefinitely strategy. And if you use this strategy and have an underwriting method that I didn't cover in this video, make sure to let me know in the comments below. And if you like this video and want to see more content like this on deal analysis, make sure to hit the like button on the video to let me know. And make sure to subscribe to the channel if you haven't already so you don't miss any new content as soon as it's released. So thanks so much for watching. I hope you found this helpful in analyzing your first or next long-term deal, and I'll see you in the next video.